We're looking at the accounting cycle. Accounting cycle reflects all the activities that are done by a business, which relates to the coding of transactions and how those transactions are processed throughout the year, from the transaction up to the time that the business is going to prepare the financial statements at the end of the year. So all these activities they happen throughout the year. So we'll look at each stage. First, we have to fill in the stages. The first stage is transaction. Transaction. So transaction can be credit transaction, cash transactions, or any other transaction that happen. So when you talk of transaction, this is an activity that involve the exchange of goods, services, or money, or anything of value between two parties. So for every transaction that happens, there must be evidence that a transaction happened, which we call the source document. Source document. So the source document is evidence that or proof that a transaction happened, business proof for everything that happened to authenticate, and also it is going to be used to record transactions in the subsidiary journal. So a source document is a proof for evidence that a transaction happened. We use source documents to record in the subsidiary journal. Subsidiary journal. So the subsidiary journal, this is the book of first ended where transactions are recorded for the first time from their source documents. So it's a primary book of prime end. From the subsidiary journal, transactions are then summarized in what is known as the general ledger. In the general ledger, transactions are posted, and the double entry is applied. The double entry is indicated that for every transaction there are two accounts that are going to be affected. For every transaction about a draw effect, there must be an account that must be debited, and there is an account that must be credited. So the general ledger shows the debit and credit. So transactions are recorded twice in the general ledger, that is on the debit and credit. Then from the general ledger, we are going to take the balances of this general ledger accounts and the totals of the nominal accounts. Totals of the nominal accounts includes incomes and expenses, and balances are extracted from the balance sheet accounts. Balance sheet accounts include assets, liabilities, drawings, and capital. So we are going to prepare the trial balance. Trial balance. As the name suggests, this statement is having a debit and credit which must be equal. So a trial balance is a list of debit balances, debit and credit balances, and totals which are taken from the general ledger accounts. And it must be, the debit and credit must be equal. So a trial balance is prepared to test the accuracy of posting from the subsidiary journal to the general ledger, of posting transactions from the subsidiary journal to the general ledger. And it is also prepared to test the accuracy of posting, accuracy of recording, mathematical accuracy, and accuracy of posting. So a trial balance is the primary source of information that is used to prepare the financial statements. So the financial statements are prepared twice a year. After 6 months, we prepare what you call the inner financial statements. And at the end of the year, we prepare the final financial statements, which include the inner elements and the other part which was not prepared. So financial statements are prepared using information from the trial balance. So the financial statements include the two statements, which is the income statement. Income statement and the balance sheet. Income statement and the balance sheet. So the income statement, it calculates profit, loss, or loss of the business using the nominal account, which is the incomes and expense. How do you calculate the income statements? All the incomes, total of the income separate total expenses. Then the balance sheet is prepared to show the financial position of the business. The balance sheet, it indicates the assets against owner's equity and liabilities. In other words, the balance sheet reflects the accounting pressures, which shows assets, what the business owns against what the business owes, which is liabilities and owner's equity. So it shows the financial position of the business. So the income statement is prepared using the nominal accounts, income tax expense, and the balance sheet is prepared using balance sheet accounts, which is incomes, which is assets, liabilities, and the owner's equity accounts.